Hello and welcome to the Wealthy Trades Options course. In this part of the options course, we're going to go over how you find overvalued or undervalued calls and puts. And I'm going to specifically talk about a monthly example, but you can use this same exact example on a weekly basis for those stocks that have weekly options. And you can actually use this same example on a Thursday night going into a Friday for a Friday expiration. And I'll explain that as we go. So what I'm going to start with is I'm on the Wealthy Trades dashboard. This is after logging in. And I'm going to go and I'm going to click on the Spyglass over here. And I'm going to just type in, I'm going to use an example in Priceline. Okay, so Priceline is going to be my example stock for this particular strategy. And I'm going to look at a monthly for now, okay? I'll see if I can find some weekly examples too. But for now, I'm going to look at a monthly. And I'm going to pull up Priceline, and here's all the monthly stats. It is June 2nd, okay? So it's one day into the month. Priceline was pretty flat yesterday. Had a little bit of movement, but fairly flat. So these stats are still valid. What you want to do is you want to price this out pretty much right at the beginning of the month, or if you're doing this on a weekly basis, you want to do this, probably over the weekend or before the market opens on Monday. But you want to do it very close to the opening period, right? So again, on a weekly basis, do it before or right at the open on Monday. Before the month, you want to do it basically either the first of the month, the first trading day of the month is the best, or right before that is the best. But for Priceline, I'm going to use an example here. So what I'm going to do is I got all this information. I'm clicked on the monthly and I typed in Priceline here. These are all this is all the information I know. Priceline, this is the main stuff I need to know. Priceline closed at 112.43. Okay, I'm sorry. It's got an expected high this month of June of $1,243.44. Yesterday it closed at 1166.66, right? The expected downside is 1164. So it's got a very, very big range. But what I'm going to do is I'm going to take all that information, all right? I'm going to take the Wealthy Trade spreadsheet. So this is the spreadsheet. And I'm going to click on the option strategy, okay? So the option strategy is what we're talking about. And what I'm going to do is I'm going to look at this column here. This is the information that I need to fill out right here in the gray. This is the information I need to fill out to find out what the proper price for the current puts and calls are, okay? And being that it's very early in the month, these stats still remain. So what I'm going to do is I'm going to use closing price yesterday, which was 1166.66. So all I'm going to do is type that in there. Levels to win high is 1243.44. So I got that in there. The levels to win low is 1164. I got that in there. The HPP high, the percentage of probability that it hits the upside, is historically is 54.2. Got that in there. The low is 37.5. Got that in there. The probabilities of it closing above the high is 33.3. Got that in there. The probabilities of it closing below the low, got that in there. Options are priced in probabilities, meaning how far should something move in X amount of days or a certain amount of time. And the way that Wealthy Trades does its data and calculates its expected highs and expected lows and the historical probabilities, we can come up with calculations on whether something is undervalued or overvalued. And again, we're going to go over that example in this video. So all I did, and I'm using a monthly basis, all I did was take the closing price and then I transferred all this data, all right, the HPP, high levels to win high, low, all that over here. Okay, that's all I did. Once I have that information, now I've pretty much got the information that I need, that I can now start to figure out whether something is overvalued or undervalued. Okay, the next thing I'm going to do is I got to find out what the current at the money call is. And I'm going to use an example in TradeMonster. You can use whoever you want. I've used all different types of platforms. I've used Interactive Brokers, TradeStation, Options House, which now is owned by, Options House bought TradeMonster. So I'm just using TradeMonster, which is now Options House. Great platform. It's not the best one. It's not the worst one. It's a decent platform. But anyway, I'm going to type in Priceline. What I'm going to do is I'm going to get a price, all right, of the monthly, or the closest to the monthly. Now here's the thing with stocks. Stocks, unlike ETFs, so ETFs like the SPY, the Qs, the diamonds, they have monthly expiration. So if I pulled up an options chain in the SPY, it would have end of June, right? A June 30th expiration. Well, stocks don't have that yet. I believe that they will be launching that, and they will be rolling that monthly expiration out for stocks soon, but they don't have it yet. So what I'm going to do is I'm going to go through June and get to the closest to the end of June as I possibly can, but beyond, right? So the closest I can get is July 2nd. So it's giving me a little more time. All I'm trying to do is get to the end of June, right? So I want to buy myself as much time as I can through the end of June. I don't necessarily want to buy myself more time because, again, I'm looking at the monthly stats, right? These are the monthly stats, so there's no need for me to go out further than that. Unfortunately, as I said, I don't have a June 30th expiration, so the closest one I can get is July 2nd. Okay, so in this example, I'm going to use the July 2nd expiration. You might be wondering, well, why don't I use the June 26th expiration, which gives me just a couple days less than the monthly expiration would give me. The reason why is because, again, these stats, all right, these stats on Priceline don't take into account just a part of the month. It takes into account the entire month. So if anything, I don't want to give myself less time, which the June 26th would. I want to give myself a little more time if I have to, right? If there's not that exact end of the month expiration, then I want to at least give myself the ample amount of time. So I'm actually giving myself 2 extra days on this, which is good. Okay, so the at the money call, as I can see, because price closed at 1166.66, is 1167.50. Okay, so you want to make sure that you're pricing out the right puts and calls. So 1167.50 is the at the money. So now I go in, and all the gray areas is where you type in. So I type in the at the money call, which is 1167.50, and then I can type in the current cost of that. So the current cost of the July 2nd 1167.50 call is $28.25. So $28.25 is what I can type in. Okay, well, get this. So that's the at the money call right now. It's June 2nd. We had a little bit of a sell-off yesterday. Nothing big. I think it sold off. Well, let me tell you here. It sold off $5 yesterday. So nothing real big on a stock like Priceline. But here's what I can tell you. So what it does is this spreadsheet will automatically take the current price and the expected high. So get this. So the current price is 1166.70, and the expected high is 1243.40. And then we know that historically, all right, this is based on the Wealthy Trades information, right? I just transferred that over to this spreadsheet, but based on the Wealthy Trades information, we know that it hits that 54.2% of the time. Okay, so what it does is it takes the at the money call, which is my 1167.50, and then it calculates the distance between the high, because I'm buying the call. I'm looking to see if is this call overvalued or undervalued. Well, the expected high is 1243.40, right? And my at the money call is 1167.50. So there's a $75.90 distance between the expected high, okay, the expected high, which is 1243.44, and current price. There's a $71 distance, right? Or I'm sorry, $75.9 distance between that. Well, how do we know whether it's fairly valued or not? Well, this is how we come up with the calculation. We know historically it hits it 54.2% of the time. So once we know the distance between the call, which is 1167.50, and the upside expectation when I'm looking at the call side, which is 1243, once we know the distance between those two, which is $75.90, right? And we know the historical hit rate of that, then we can calculate what that call should be, the fair value of that call. Because we know if it hits it 54.2% of the time, then the price of that should be 54.2% of the distance. Okay, so the distance is 75.9, the distance between 1243, that's the expected high, 1243.44, and 1167.50 is 1243.44, 1243.44, and 1167.50. The distance between those two is $75.94. Well, we know it hits that 54, so we could take that number times 0.542, and we know, and the spreadsheet automatically does this, we know that technically the fair value of that call, now we're not going to pay fair value, we want to get a discount on that call, but the fair value on that call is $41.15. We get that because we know it should go up to 1243.44. The at the money call right now is 1167.50, and it hits that 1243.44 54.2% of the time. Therefore, the call should be a fair value for that call should be priced at $41.15 or $41.16 technically. Well, we want to get a discount on that. So the max call. So again, it does this all for you. Let's say that the hit rate wasn't 54%. Let's say it was 40%. So I type in 40%. Well, as you can see, look at the call price changed. The fair call price changed. So it automatically does that for you. So you don't have to do any of that. It does it for you. But what was it? 54.2. Let me just verify. Yeah, 54.2. Let me put that back in there. But we know it's 54.2. So what we know is technically, yep, the fair value for that call is $41.16. We do a discount though. I want a discount of about 25% on that minimum, 25% on what Wealthy Trades will consider fair. So we do a 25% discount on that, which is essentially gets us down. I'm sorry, it's a little less. It's about a 20% discount on that, but we're looking at a max call price that we would look to potentially buy at of $32.92. And again, we just take an equation that gives us a discounted value. Okay, so that is the max price that we will be willing to pay for this. Why do I like this trade? Well, here's what I really look for is this is obviously a discounted call option that I should be willing to buy because I can buy it for $28.25, right? We priced that out in Trade Monster. It's currently trading at $28.25. Well, the fair value is $41.16, and even at a discounted value that Wealthy Trades comes up with, it's under. There's the open. But why do I like this? Well, here's the reason why I like it. Anytime I can get something that I know hits the trend side very often, and it hits it over 50% of the time. Anytime that I can get something like that under 50% of the distance, then I like it, right? So remember the distance between 1243.44, because that's the expected high, and the at the money call, which is 1167.50, is $75.94, right? Well, 50% of that would be $37.97. So it's substantially discounted. Okay, so I really, really like that. Now let's do the put. So the at the money put is going to be the 1167.50 also. Let's price out what that put is. So I'm going to go over to Trade Monster. I'm going to go to the, remember, and the thing I like about this too is we're getting 2 extra days. So not only are we buying at a discount, but we're actually getting 2 extra days because we're out to July 2nd, which is good. So the at the money put is $1167.50. The cost of that put is $29.30. And the fair put, all right, the fair put should be priced at $25.07. Our cost, or what we are willing to buy it for, is $20. So this is actually overvalued. So we're not going to look to buy the put. Why is it overvalued? Because again, think about this. It's the same calculations. The at the money put is $1167.50. The expected downside is down to $1,164, right? So the distance between those two is $66.86. That's the distance between the at the money put and the expected downside. It only hits that level 37.5% of the time. So we take that number times 37.5, and you don't have to do any of this. It does it all for you, and it comes up with that fair value. We then do a discounted equation on that. So these green numbers are the minimum. Are the maximum amounts that you should be willing to pay for these. So the call is undervalued. So buying it for $28.25 is a very good value that I like. It's a trade that I absolutely like. I like buying the 1167 July 2nd call and price line for $28.25. Now what would my target be? Well, the target's simple. The target is, I'm targeting that expected high, right? The expected high is 1243.44. And I'm buying the at the money call of 1167.50. So my target's going to be the distance between the call and the upside. So $75.94. So think about this. I'm willing to buy this. Why am I willing to buy this? Because it hits at 54.2% of the time. I'm buying it, right, for $28.25. my target is going to be $94.95. That means if I hit my target, then I make $47.69 per contract. That's my profit potential. I've got 54% probability of hitting that historically. So I'm risking, think about this, I'm risking $28.25 to make $47.69, and I've got over a 50% probability of doing that. That's a phenomenal trade. On the put side, it's overvalued though. And again, all you got to do is calculate. So this is all the information that we get from Wealthy Trades, the closing price. And you do this if you're doing this on the weekly basis, just on the weekends, put the closing price, the levels to win high, low, HPP high, low, and then levels on levels. And then you just calculate the at-the-money calls. It's that simple. It's absolutely amazing. And then these yellow prices give you the fair price, which again really doesn't even matter. I should maybe even take those out, because the green is the discounted price, the max discounted price you should be willing to pay. So for the put, the only way we would buy this put is if we could buy the 1167 put for $20.06. Our target on that again would be the distance between the at-the-money put and the expected downside. So the at-the-money put is 1167.50, and the downside is 1160. So our target would be about $66.90. So we'd be risking $20.06 to make $46.84. So again, that's if we could pick it up for that. But the call is a great buy, and I'm going to actually add down here. I'm going to add what your target would be. I'm going to add a target down here. So when you guys get the spreadsheet, you will see what your target will be. So you don't have to do the calculations yourself. The target's real simple. As I said, it's the distance between the expected, on the call side, the expected high, and you're at the money call. That's your target. And then that gives you your risk to reward also. So that is how we calculate whether something is overvalued or undervalued. Just to recap, this is a monthly basis. All I did was I took the spreadsheet. It's the same spreadsheet that you use on a weekly basis. All I did was transfer these numbers, closing price, levels to win, high and low, right here into the spreadsheet. And then I went into Trade Monster. You can use whatever options platform you want. I looked at the at-the-money call out to the as close to or beyond the end of the month as I could, because remember, we're looking at monthly, so I went out to July 2nd. All right, so I went out to July 2nd, put those in, put the at-the-money call strike, and then I put the price, and then it does automatically calculates what I should be willing to pay for that automatically. So if I wanted to, let's say I was bearish, right, which I don't know why you'd be bearish because we're in an uptrend, but let's say I was bearish, I could automatically go in and then say, well, I really want to buy that put. Well, if you want to buy that put, that's fine. Just put a limit order in to buy that put, because let's say you're bearish, put a limit order in to buy the put at what Wealthy Trade says is the max value you should buy the put at, which is $20.06. That's fine. Go ahead and do that. That is how we calculate the max amount we're willing to pay for a naked put or naked call. In the next video, I'm going to talk about how you price out bull put and bear call spreads for income trades. Using these exact same levels to win information, how do we calculate whether we can sell spreads, a bull put spread or a bear call spread? That'll be in the next video. I would recommend watching this video a couple times. Again, all it is data entry. Put the information here, whether it's on a weekly or monthly basis. If it's a weekly basis, over the weekends, transfer the Wealthy Trades information here. Look for the at-the-money call and the price, at-the-money put and price, and it automatically tells you what you should pay for those. It's super simple, based on the information Wealthy Trades calculates and the historical hit rates. Very, very powerful stuff, and it helps you find undervalued options, much like this price line option, this 1166.50 price line, or 1167.50 price line option out to July 2nd. If you can buy it for $28.25, that is a phenomenal deal. It's a good trade. Target should be the distance between the upside high, which is 1243.44, and 1167.50. My target's going to be $75.94. Again, like I said, I'm risking $28.25 to make $47.69. It's a great trade, and the spreadsheet does it all for me. I know it's undervalued, and it does it all for me. Let me know if you have any questions. Next video, we will talk about spreads, bull put spreads and bear call spreads.